Okay, I just want to thank everybody for coming today to learn about a little bit about financial documents. I know everybody's probably thinking that this is going to be something that's maybe really boring, so we'll try to pep it up a little bit. What is, when you think of the financial status of a business, what would be the purpose of the business having financial documents? Does anybody know? What is the main reason that our company is in business? Yes, we like what we do. We have a good product that we're manufacturing, but one of the biggest reasons we're in business is because we want to make a profit. Well, how does the business know whether they have a profit or not? So we're going to look today at how a business knows that. We're going to look at our financial statements. We're going to look at why a business should have a budget. We're going to also take a look at employee payroll, financial forms, transactions, and bank reconciliation, because all of these are important. So as we stated, we're going to talk about financial statements, and the main reason we have financial statements is because they tell us how well our business is doing as a company. So we're going to look at income statements, balance sheets, and our cash flow statements. So the income statement for our company, it tells what the company's performance is over a certain period. Usually we do these monthly, and then we also do them quarterly, kind of put them all together, and we also can do them on a year-end basis. And the income statement shows the product, the sales that we've had for the accounting period. It also shows the expenses that we had for the same period. And the difference between those two is either a net income or a net loss. Most of the time, a business always wants to have a net profit, because if you have a net loss, that means your expenses were more than your income and your business did not do very well for that time period. The reason we do the income statement first is because the net loss or the net profit goes on our balance sheet in either the owner equity or the shareholders equity portion of the balance sheet. And the balance sheet is our assets, which are any of the goods that are owned by the company. The liabilities is any debt that is owned by the company. You have current liabilities, which are usually paid off within a year's time. And then you also have what's called notes payable, which is long-term liabilities that you're going to pay on over more than a year. And then you also have the owner's equity. Sometimes this is called stockholders' equity or shareholders' equity. It depends on the type of company. For our company, it is called stockholders' equity. And what this is on the balance sheet, your assets always have to equal the total of your liabilities and your owner's equity. Those two have to be in balance. And normally we prepare that on a monthly basis, and then once again at the end of the fiscal year. Since we're talking about, we mentioned fiscal year, who knows what a fiscal year is? Does anybody know? Well, fiscal year is a 12-month period. It can run from June to June. June to May. It can run from August to July. It's any 12-month period. It doesn't have to run with the calendar year. The other thing that we like to really pay attention to, and normally we do this either monthly or more often if we need to, is our cash flow statement. We need to know how much cash is coming into our company and how much is going out for expenses. It's very similar to an income statement, but this one takes into account pretty much any income, any money that comes in and any money that we spend out. So it's kind of like our checkbook register a little bit, but it takes care of like cash, credit, and all sorts of things like that. So we've looked at the financial statements. So how do we determine whether the amounts that we see on the financial statements are what they need to be for our company? The way that we know that is because every year the company sets a budget. Just like we have a personal budget, our company has to have a business budget so that we know how much we can spend in sales or product or whatever it is that we're doing. We need to have office supplies like copy paper and stuff, and so we need to know how much we have allocated for that. So it's a little bit difficult as it is for a business to set a budget up, just like it is when you're trying to do a personal budget. But once you get it set up, then you can tweak it or move things around as you need to, depending on what your money coming in and things like that, or if you have extra expenses or something. So a budget is really important. The other thing that we have as a business, and everyone is, I'm sure that's in here, is familiar with, is we have our payroll. So you know that when you get your paycheck, it's going to be short. It's not going to have your gross income on it. Because you're required to pay your federal and state income taxes out of that, and your Social Security and Medicare taxes. As the company, we can also take out, if you authorize us to do so, for your insurance, retirement, the stock options of the company. You might have a health savings plan, and you also might participate in our short-term and long-term disability. So this is, if your paycheck is automatically deposited, you might not have any idea really how much is coming out or how much is going, or why you're getting what you get. But if you go on to the company website, you can pull up your payroll information, and you'll see a sheet that looks similar to this, and it will list out everything that is being withheld for this current pay period and for what it has been for the year. As a company, back in our accounting department, they keep track of all of this on what we call our payroll register. And it pretty much just lists the employees, and it shows all the deductions and the net that we paid. And this is what we use to be able to give you those handy dandy little W-2 forms at the end of the year so you can file your taxes. The last financial forms and transactions that our company deals with that I want to talk to you about is our petty cash and purchase transactions. One of the reasons that we have petty cash is because, let's say that, oh my goodness, we ran out of stamps and we need to go to the post office. We don't want to have to spend, we don't want to have to write a check to go get a roll of stamps or something, so we keep petty cash for things like that. Or if we have, for whatever reason, nobody can find pens, or we ran out of sticky notes or something. So usually we keep $200 in our petty cash account. In our company, we have just one person that's in charge of that. So if you need money for something, you have to go to this specific person. We do keep what's called a petty cash voucher, which is the same as a record, and it shows what our starting balance was, the expenses that came out for the month, and then whenever it gets to a certain amount, our company's determined $50 is the lowest we want that to go, then we'll write a check and we'll replenish the petty cash fund. The other thing, and this is where everyone here is involved in, is the purchase of transactions, or purchase transactions. So when we make purchases as a company in the purchasing department, which is where you all are from today, you can't just go and say, well, I want to order this much stuff. You have to know that you have to have an approval for this, and that you have to submit a purchase requisition. And the purchase requisition just says, this is who we're going to get it from, this is what I need, this is how much, and this is what the price is going to be. And then you have to have the signature of the supervisor saying that that's fine for you to go ahead and order that. So once we have our approval on our purchase requisition, then we send that over as a purchase order, and we send that to the vendor. We tell them who we are, what it is that we need, how much we need, and we actually order that. Once we order it, then the company sends it to us, and our purchase arrives. And when it gets here, the following steps that we do, we need to verify everything that's on the list, make sure it's included in the box. We need to compare to make sure that it matches what we ordered on our purchase order, and we also need to make sure that we've got the right product. And then we fill out our receiving report, and that just shows that the purchase order is closed and that all the items on the order were received as they needed to be. So on this is just a recap. Once we sign off of it and that we've received it and everything is fine, then we're going to end up getting a bill from the vendor for the invoice. And then we're going to produce a payment voucher that tells us in accounting that it's okay for us to go ahead and pay it, because you know about the invoice and it's been approved and everything is like it needs to be. Oh, bank reconciliation. Since we all have bank accounts, we all know that we should be reconciling them at least every month. With computerized banking and things, we're not as apt to do that. But as a company, we do that. What we do, we get our bank statements and we confirm that all of our deposits are on there. We verify that all the checks that we say have been processed. And if we have checks that the bank statement is not showing, then we want to make note of that also. And we also pay attention to whether we've had any service charges or other fees for the month, and whether they've added any interest to our account. So whenever we have done that, then we can determine whether we have what our adjusted cash balance is. And we do that on our bank reconciliation form. And this is something that we've created on our Microsoft Excel spreadsheet program, and we just update it every month. On the left side, we have our checkbook register balance. We deduct the service charge from the bank or any other fees from the bank. We add our interest in, and then that gives us our adjusted check register balance. When we know what that is, then we go to the bank side and we take the bank statement balance. We add a deposit that maybe we've made in our checkbook register but the bank hasn't made. And then we subtract off any outstanding checks. And when we get to that, just like on the balance sheet where the assets equaled liabilities and owner's equity, our adjusted checkbook register balance and the bank adjusted bank statement balance have to match. And if they don't, then we have an error and we need to find it. So this is just a little bit of what we talked about. We talked about our financial statements that are important to us as a company, which are our income statement, our balance sheet, and our cash flow statements. We talked a little bit about how our company has to have a budget and has to stick to it so that our financial statements come out like they need to. Showed you a little bit about the payroll forms and things that we use as a company. And then we also looked at financial forms and transactions, which were our petty cash and our purchase transactions, and then kind of how we as a company do our bank reconciliation. And so this is, these are just some important forms that we have as a company, and now everybody kind of knows a little bit about if you hear somebody say, well, did you check your payroll register? What did it say? If we ask you that when you call and have a problem, then you're going to know, oh, that's what they're talking about. Or if we're in a meeting and we say, well, our balance sheet or our income statement's not looking good, we're going to have a net loss, possibly. We need to work on some sales a little bit. That kind of gives you an idea of what it is that we're talking about. So does anybody have any questions for me? Anything that they didn't quite understand? I know it was kind of a quick run through, but are there any questions? Okay, well, since there's not any questions, I just want to thank you for coming again to the presentation, and if you have any questions at a later time, just let me know.